Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Joining me today is Dave Gill. Welcome, Dave.
Good afternoon, Mike.
And Dave's here to talk to us about our industrial and technology sector. And so, Dave, why don't we start off? We were just talking before recording the show, and in terms of earnings seasons, reporting seasons, got a good feel for what happened in Q4. How did businesses do in industrials and technology?
Yeah, so there's a lot to unpack, as you would imagine, Mike. We began the year with a viewpoint on industrials and information technology, largely in line with the way we exited 2024. And when we look at the space, broadly speaking, and of course we're making generalizations across the sector, underneath the hood, there are always good opportunities. But if we just take a step back and look broadly at the sectors from above, we exited 2024 with the viewpoint that both technology and industrials looked somewhat elevated from a valuation perspective, both on a relative and absolute basis. Technology obviously was getting an uplift from the secular tailwind of Gen AI and all the excitement surrounding that and optimism surrounding that. And then, obviously industrials, a bit of a tailwind from the fact that, we've seen growth sort of improve. We've had a more accommodative Federal Reserve and central banks. And so these cyclical type of sectors generally try to front run improving macro. So in our view, these two sectors got ahead of themselves. And I think that if you look at that viewpoint so far in 2025, both sectors, that thesis has kind of played out as both sectors have kind of lagged the rest of the market on a year-to-date basis. For technology, I think it's more of a sort of a derating. The multiples were high, so I think what's happened is that we've seen multiples come down a little bit in that space, although they remained elevated. The fundamentals are still very solid. For industrials, they're still very solid as well. There, it's less of a valuation thing and more of a marking down of expectations on both the top and bottom line. So that's what we've seen on a year-to-date basis. But for the most part, we favor other parts of the market right now relative to industrials and technology.
And it's always good to understand, how is the market reacting in terms of the businesses themselves, though. Are they, are their earnings still solid, still seeing some growth there, or what are we seeing?
Yeah, I think for the most part, fundamentals are still supportive. I think our issue has been mostly on the valuation side for these two sectors. Having said that, I think sort of en masse, the earnings performance in the industrial space has been a little bit more underwhelming. And I think that guidance for coming quarters and for the coming year have been a little bit underwhelming versus expectations. And I think part of that is just a cautious tone out of management. We really don't know what's going to happen. This is a very dynamic, very fluid situation with regards to tariffs. And so I think companies are taking more of a conservative approach. Nonetheless, that seems to be weighing a little bit on the stocks at this point.
Like every good PM, you brought up the T word, not taxes this time, but tariffs. It's come up in every one of the podcasts, and as well it should. You talked about the uncertainty. So let's go there. What are your views? What are you watching for? I guess it's pretty hard to predict, which way the wind's going to end up blowing on this one. But any thoughts from a perspective of tariffs and industrials and technology?
Yeah, there is obviously a lot of moving parts, very difficult to figure out. But, just for my own benefit, what I've done this quarter is pay particular attention to what management is saying. And so for every company that we own, I've listened sometimes more than once to what the company managements have said in their conference call with investors. And so I developed basically for my sectors a bit of a tariff scorecard, if you will. And at this point, as of today, we've got about 85% of the companies in my spaces have reported. Of those companies that have reported, about 90% of the companies are mentioning tariffs as an issue, as sort of a headwind, as something that may impact the business itself or customers and end markets, or really just the broader economy from the perspective of potentially lower rates, weaker currencies, potentially higher inflation, maybe some growth headwinds. So both macro and micro factors have been pointed out by management. I think that the general consensus, though, if I were to try to sum it up in a very succinct kind of way, I would say that overall, the impact from tariffs, I mean, we don't really ultimately know their final state as of yet, but nonetheless, it's that the overall impact from tariffs is not overtly negative. It's more mixed, I would say, at the company level for most of the companies that we tend to follow.
Okay. Any companies you want to talk to, maybe focus in a little bit more on in detail in terms of understanding how they're doing?
Yeah, absolutely. Always like to highlight some of the quality companies that we tend to select for our investors. The company I'd love to talk to about today is Deere, just because it's actually in the crosshairs. It really does sort of check all the boxes with regards to some of these challenges that we're facing in today's market, the political landscape and otherwise. But before I get to that, maybe just another key takeaway that maybe I'm going a little bit off course here, but I thought, I was thinking about this tariff scorecard and what management for a lot of the companies was saying. And one of the things that struck me is that it appears to me that the companies that we follow appear to be better prepared than the country we live in. So basically, the management teams of the companies we own are better prepared than the management teams of the country we live in. That's sort of my takeaway.
I'm not surprised. I think most especially our clients, right?
Yeah.
There's small to medium sized businesses, and I don't think they're surprised. And that lets me sleep a little bit better at night. I mean, look, I don't care what side of the political spectrum you're on. It really does come down to the working companies and the working people that drive the economy. And so, yeah, I think that's a good observation. In fact, and it's a great observation that, especially in these times of uncertainty, that it is going to be at that level that, yes, we can put a lot of emphasis on what the politicians and the institutions, say the Bank of Canada, may or may not do. But it is really down to the smart management teams in terms of, okay, they deal with constraints and obstacles all the time. And so many that, the average layperson wouldn't even know is there. And that's their job. That's what they get paid to do. So that's a really good observation.
Mike, just to expand on that a little bit and sort of in line with what you're saying, what exactly am I talking about? Am I trying to get political? No, I'm just being realistic, being pragmatic. Like if we look at it, what have these management teams done? Like if you look at the rolling series of crises that we've been through since 2008, these management teams have increased their agility. They've become more efficient operators. They've optimized their supply chains. They've diversified their revenue streams. They've solidified their customer relationships. They've developed an ability to flex their production, the location of their production facilities. And they have the ability to pull multiple expense levers and even raise prices if needed. And then you juxtapose that with sort of what we're doing at the country level and the more recent rhetoric, like in terms of the response that we're going to take as a country to this threat. It shines a light on the fact that we're way behind the private sector, obviously. And again, to your point, it doesn't come as any surprise to anybody. But, what are we talking about now at the provincial and federal level? Well, we're recognizing that there are a lot of self-help opportunities for Canadians. There's room for definitely more government efficiency, less regulation, increased trade within Canada, and then to diversify our export markets. So if you think about that and you stand back and you go, well, here's a situation where we're lagging behind as a country and the private sector is already adjusted and it's already well prepared. And that's what we're seeing out of the management teams that we own for our clients.
Really good observation, Dave. And I know we don't want to drift into the geopolitical, but sometimes you have to. And, the mere fact that we have these trade barriers between provinces, it's, again, I said it on a previous podcast. I was around when Mulrooney and Turner were debating free trade back in the late 80s, early 90s. And I'm a free trader. If you can't compete, get out, and that's how business works. And I'm not sure anything good will necessarily come out of tariffs, but one thing maybe that will be good is to bring down those barriers between provinces, and that's simply politics and interest groups, and I get it. I know, sometimes people were trying to do the right thing, but maybe some sanity will be brought in even within our country. But I know we're diverging off of industrials, but a great observation. And again, it always just gives me comfort. That's why I'm a capitalist, and that's why I believe in business, because again, it's back to the individuals that can make decisions, the management teams to deal with the challenges as they come. May take time, may take some, as you say, for example, revectoring production. Or the like, and which is something it may be sad to see, but at the same time, if they have to adapt, I think your point is, well, we have a high level of confidence that the management teams we're investing in will do it.
Exactly.
Yeah, good stuff. So let's bring it back to you were talking a bit about John Deere, so the Deere company. Talk a little bit more about that.
Absolutely. It's a name, that we've held, and we've liked, for our clients, for some time. And there's a lot of good reasons behind that view. If you look at the company itself, it's got a great history. It's a great story to tell, and one that's been told in many client meetings, I'm sure, over the years. But, for those who don't know, this company has over about a 200-year history, believe it or not. It was started by a guy named John Deere back in the 1800s. He was a blacksmith. He was an innovator. He actually created the first self-scouring steel plow back in the day. So the company was born from innovation. That's obviously a good thing, because, as you know, coming from the tech space, the companies that tend to innovate tend to lead. And so that's one of the reasons why we like John Deere, for its play on innovation. The company's ubiquitous logo and green and yellow equipment, they're recognized around the world. And I think another thing a lot about is the importance of brand equity. And brand equity generates real value for firms in general, and it does so for John Deere as well. Basically, it allows them to differentiate their product in the marketplace, which can reduce marketing costs. It fosters customer loyalty, which can boost revenue through repeat business, and it can convey quality. And when you convey quality and your name, your brand becomes associated with quality, it gives you the ability to raise price. So it effectively creates a bit of a moat around your business, and John Deere has all of these things. The company's based out of Moline, Illinois, and today it generates about $50 billion in sales and employs about 75,000 people globally. Now it sort of operates around three key segments. So it's production and precision agriculture, small ag and turf equipment, and then construction and forestry. But most of its sales are derived from basically large farm equipment. So combines, tractors, harvesters, sprayers, things of that nature, related parts and equipment. Most of its sales, so call it 60%, are concentrated in the U.S., but they deliver into end markets in Latin America, Canada, and Europe as well. If you look at the company's recent performance, it actually hasn't been that great, to be honest with you. It's a cyclical business. If you think about their end market, it's farmers. And, the health of farmers depends on farm fundamentals, and farm fundamentals are a function of things like farmer net income. So net income is just revenue minus expenses equal net income. And for farmers, the revenue comes in the form of receipts, and receipts are dependent upon commodity prices. And if you look at commodity prices for major crops like, corn, wheat, soybean, all of these prices have come off since their peak in 2022. The peak in 2022 was created from the dislocation of the Russia invasion into the Ukraine. And since then, commodity prices have softened up considerably. And of course, just like the cost of living has gone up for you and me and the rest of our listeners, basically what I would say is that that's essentially pinched margins. So if you think about farmer input costs, it's for things like fertilizer, rent, feed, seed, labor, interest rate costs, all of these things. And so the bottom line is farmer fundamentals are cyclical. Right now, commodity prices are low, costs are elevated, the squeezed margins. So there's less money to go around to buy things like new equipment that John Deere sells. So we're at a sort of a trough in the cycle for farm fundamentals. And if just to put that into context, a couple of years ago, Deere was earning about $35 US a share. I think last year they earned about 75% of that. So it's down about 25% off the peak.
Okay.
So right now it's a very challenging environment for Deere, but I spoke about some of the things which differentiate Deere in the marketplace. And another key angle to this story, which I don't think is widely appreciated, is that, how would you react, Mike, if I told you that Deere is really a play on technology?
I used to own one of their lawn tractors, but okay. So my eyebrows are up a little bit, but yeah, keep going.
So this is a firm which actually has a tech stack. And so, over the last 20 years, Deere has been investing in their tech stack. So they've been through sort of inorganic acquisitions and organically through R&D. I think they invest about, call it 5% of their top line, certainly more than their competitors. They've been investing in tech. Right. And so now they have, I think 1.5 million, connected assets around the world, meaning that, tractors, combines, harvested, all kind of have telematics or software, hardware in the actual cabin, which is collecting data and sharing that data with an operations center and then sharing that with farmer advisors so they can improve things like efficiency, costs, productivity, yields. And so this all feeds into this theme of precision agriculture. So one day, and the hope is that John Deere will enable farmers to basically manage farms at the plant level. Now, if you think about that's almost a crazy assertion or notion, but that's ultimately what this company wants to do, and they're well on their way. So I think, back to that history 200 years ago, where John Deere, the blacksmith, invented this first self-scouring steel plow, to today, where it's a leader in connected assets and data, automation, robotics, AI, machine learning, with technologies like See and Spray. So actual equipment and attachments to equipment that can actually, look and in real time identify whether a plant is a weed or part of the crop. And this is the technology that they have, and they're on the front edge of that wedge right now. And so it positions them well into the future, and that's one of the reasons we like it. We think it's going to be good for market position, for pricing, for margins. And if you look at it, it's all playing out. They've had sustainably higher margins than their two peers, which would be AGCO and CNH Industrial, really over the last several years. And we think that is going to continue well into the future. Now, just very quickly on the tariff front, this is a company which is not immune to the tariff storm. In fact, I think it was back in the fall, President Trump actually called out Deere specifically. As I said, the company's going through a bit of a downturn, so it's trying to optimize some of its manufacturing footprint. And so it announced that it was moving some of its production to Mexico. President Trump did not like that and specifically called them out in the media and said that he was going to implement a 200% tariff on Deere's imports into the U.S. So, I think Deere hasn't really responded to that, but they have come out and just clarified that I think most of their U.S. sales come from equipment that is manufactured in the U.S. by U.S. employees, and a very small proportion comes from Mexico and other countries like Canada and Europe. And then from the cost of goods side or the input side, I think only a small proportion, I think it's about 10% of U.S. manufacturing cost of goods sold comes from Mexico as well. And then only 2% from China and 1% from Canada. So if you think about that, take a step back and you think about those numbers in the context of Deere, it's a very manageable headwind for the company, which is why we remain constructive on the name on a go-forward basis.
Excellent example of some of the challenges back to, the management teams, these are smart people. They'll figure this out. And even back to the, I'd say the madness of tariffs, because we have, John Deere is a global company and they compete against other global suppliers. And so, again, whatever spectrum you're on with respect to President Trump, Deere has to, it has to do what it needs to do in order to compete on a global scale. And so that was the whole point of the free trade agreement between, the North American countries, Canada, Mexico, and the U.S. And so now he's trying to undo that, but that just means the United States, well, what? You're not going to be an exporter in the end? And, of course they will. So again, you hope some sanity will prevail, but it's a great example, Dave.
Yeah.
Well, and, we've talked about basically the biggest headwinds right now, I would say, unless you disagree, is kind of what is going to happen on the tariff front, if anything. And, are there any other headwinds that you're watching with respect to this sector?
Well, I would say that, because both of these sectors are very cyclical, they're very much attached to the macroeconomic outlook. And
Right.
If you think about the biggest risk to the outlook right now, it really is a function of what happens with tariffs. I mean, pre-tariffs, the outlook for, sort of the macro in North America and really rest of the world was that, growth was going to be somewhat similar to growth rates from last year. Yeah, I would describe it as overall kind of sort of tepid growth, but it's good enough growth because companies are showing the ability to grow top lines by, call it mid-single digits, and bottom lines by low double digits or high single digits. That's good enough for, these companies. So I think the outlook was relatively somewhat positive. And now you bring in tariffs, it's just more uncertainty. If I was pressed, I would say my baseline is that we're not going to see, universal tariffs, but what we will see is just a situation, of sort of a rolling series of headlines throughout, this administration's term that, will create probably bouts of volatility. And so, the best way to prepare for that, for us, it's just, again, like I said before, stick to the blocking and tackling, pick good companies, make sure that they, are run by good quality management teams, have things like strong brands, good balance sheets, diversified earning streams and markets, things of that nature. And, that's what we're doing to sort of, navigate through through the tumult of the tariff storm.
Good summary of our quality attributes in the Q sector approach. Dave,
Yeah.
Thanks so much for this.
Yeah. Thanks very much, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor at your accounting firm or talk to your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.